Joining us right now is Minneapolis Fed President Neel Kashkari. Neel, what do you think? Just in terms of what happens with tariffs, with the trade war, what would that lead you to think the Fed should be doing?
Well, good morning, Becky. I think it's far too soon to know. So far, there's been a lot of bluster on both sides about trade over the past couple of years. We haven't seen much evidence that it's showing up in the aggregate economic statistics. I think most investors, and I'm certainly in the camp where both China and the U.S. have far more to lose, and I'm hopeful that cooler heads will prevail and this won't go down a very nasty path. Obviously, if it's the worst-case scenario and it's ever-increasing tariffs for an extended period of time, that could change things. That could have a real effect on U.S. GDP growth. But right now, I'm not seeing it, and so I'm in a wait-and-see mode.
Where would you see it? Would you be watching the inflationary figures that we normally watch? Would you be watching growth figures? Where do you think it would show up?
I think in both places. So as Steve said, there would be somewhat of an upward adjustment in prices from the imports that we're buying from China. But then I think the bigger effect, as the other economists noted, is that there could have an effect on psychology, could have an effect on markets, could then have an effect on investment. If U.S. corporations are nervous because of global trade dynamics and they pull back, that could then have a much bigger impact on the U.S. economy overall. But when I reach out across my district, there's no question that farmers in my part of the U.S. are feeling some of the bite of the trade battles, soybean exporters, for example. But by and large, most businesses in my region are still feeling quite optimistic about the U.S. economy. If that sentiment were to change, that's something we would have to pay attention to.
Neel, we talk all the time about where we are in this cycle. Is it late cycle? Is it end of cycle? What is your expectation, just again, based on what you're hearing from people and companies in your district?
Well, I think it's a mixed, there's some mixed signals. On one hand, we've got overall pretty healthy U.S. economic growth. The job market just last week put up over we're averaging 205,000 jobs a month, which is remarkable this year. If we were really at maximum employment, the U.S. economy should not be creating jobs at that rapid rate. So the job market seems very healthy. Wages are slowly ticking up. That's also good for consumers. It's also a good economic indicator. At the same time, I look at the yield curve. I look at the bond market. The fact that the 10-year, as Joe said earlier, is around 240 this morning says that bond investors, at least, are signaling slower growth in the future. And so I think right now we're getting different signals from different parts of the economy, but the fundamentals of the real economy appear to be quite healthy right now.
Neel, what are you hearing from the inflation numbers that are out there? They're down in the 1.5%, 1.6%, and sort of moving the other way from your target. Do you see this decline in inflation as transitory?
Well, you know, I'm not so much in the transitory camp because it's been pretty consistent for the past 10 years. I think over the past 10 years, core and headline inflation have been averaging 1.6%. Our estimates at the Minneapolis Fed, we look at inflation expectations, we think are anchored at around 1.7%. So to me, that is an evidence that our own monetary policy has done that. We've been tightening. We've been raising interest rates when inflation has been below our 2% target. For me, we've been demonstrating that 2% is more of a ceiling than it is a symmetric target. And so I personally think that we need to act as though it's a symmetric target, let inflation continue to build, let it actually go above target for some period of time to demonstrate that we're serious about that symmetry.
But at what point, Neel, when you keep missing your target, does that require a response on the monetary policy side?
Well, it could. There's no question. I mean, if we saw job growth really slowing down, then you might say, well, you know, the U.S. economy is slowing and we're really going to anchor these inflation expectations in at 1.7%. We need to do something. I'm not quite in that camp yet because we continue to see the job market exceed expectations. As you know, Steve, we need about 100,000 jobs a month to keep up with population growth. The U.S. economy is creating 200,000 jobs a month, and wages are slowly picking up. I still think there's slack out there, and as the U.S. economy uses up that slack, more people come into the workforce, we'll see wages climb, and eventually that will pass through to inflation. So I'm not giving up on a long-run Phillips curve story. I just think we've been underestimating how much slack is there.
Neel, I just want to point out that while we've been talking this morning, the futures have taken another leg down. We're now looking at the Dow Futures implied down by almost 400 points. Do you think that's an overreaction by the market or not, just based on how the market's trying to figure out what's happening with these China trade talks?
My guess is it's just a lack of news. You know, it's a low information people are trying to assess it, so you see this kind of volatility. I don't think your viewers, or certainly we, should be paying too much attention to short-term movements like this up and down in the stock market. I think it'll take more time before any of us know where these trade negotiations ultimately are going to end.
Hey, Neel, a separate question, somehow related to where the stock market is. We've been talking a lot about Uber this morning. I wonder whether you think there's a bubble in private market valuations that isn't being accounted for in all of this.
Well, there could be, but I think private market investors are well positioned to take any kind of repricing. And so if they, paid up rounds and then the public markets don't reward them, I think they're in a good position to be able to bear whatever those losses are. So that doesn't give me too much concern.
We should probably break in here, Steve. You want to just read what's going on here? Because this may
the new Reuters headline. Joe, do you got it?
Yeah, China plans to set import tariffs against $60 billion worth of U.S. goods, taking effect on June 1st. It will impose tariffs ranging from 5 to 25% on U.S. goods. That hit about 2 minutes ago.
Looks like that's why the market took another leg down.
I saw it happen and kept trying to click on it. Yeah.
It wasn't Neel's comments. It was.
Yeah.
Well, you're not helping, Kashkari.
Neel, you said you think cooler heads will prevail, but in the meantime, we're going to have to watch every headline that comes out.
We are going to have to watch these headlines, and it's going to be more volatility. And I think Steve said it's very hard to put probabilities around these different possible outcomes, and that's what makes the analysis so difficult. So all of us are somewhat in wait-and-see mode. But I think relative to China, the U.S. is in a very strong position. Not only is our economy bigger, our economy is much less sensitive to trade. Trade is important to the U.S. economy, but it's much more important to the Chinese economy, just as a share of its economy. So if there is a tit-for-tat strategy here, and I'm not advocating it, but a tit-for-tat strategy would seem to lean towards the U.S.'s strength rather than China's strength.
Neel, there was a note out from Morgan Stanley today saying that the FOMC is likely to take fund rates to zero next year if there is even a mild recession. You'll be a voting member on the FOMC next year. Does that sound like a likely scenario?
Well, I hope not. I think that I was more nervous 6 months ago when, the path that the committee was forecasting were continued hikes. I was more nervous about what that monetary policy path would do to the real economy. The fact that the committee has moved and we're now paused, I feel pretty good about where we are. I think we have rates roughly at neutral. And again, if the job market continues to be strong and if GDP continues to be strong, then I'm optimistic that the expansion can continue. The one area that's, other than trade, the other area that is really flashing a yellow light is, of course, the bond market with the 10-year where it is. Investors are signaling more cautious economic growth. So that's something I'm paying close attention to. An inversion of the yield curve, I also think, is something we're all paying close attention to. So it's not all green light from here, but I think the fundamentals, at least so far, are strong, and we want to do our part to keep the economy growing.
Neel, maybe you could explain to us, on net, do you see the impulse from tariffs being inflationary or deflationary? Obviously, tariffs raise prices, but then the effect on economic growth seems to go the other way.
Yeah, I think you described it well. The one-time repricing boosts prices at least one time, but then if it has a broader hit to psychology and then that reduces investment, then I think that would be probably the bigger effect. But of course, these things, as you said, are hard to model out, and so we'd have to a little bit see how they play out, see which sectors are impacted, see if there's any kind of a fiscal response to support the sectors that are most directly impacted. I mean, again, in my region, as I travel around, farmers a lot are feeling some of the bite of the tariffs.
Can you put some color on that? Because the Fed, in its recent financial stability report, talks specifically about the rise in default in agricultural loans. And I've heard from other bankers that they're not taking up the loans that would be normal this time of year for replanting. How much is the agricultural sector in your district feeling the effect of tariffs?
Well, they are feeling a lot of stress, and they've been feeling stress for a number of years, but it's hard to separate out how much of it is tariffs versus how much of it is recent flooding versus the fact that year after year after year, the ag sector in general just keeps putting up record crop production. And if you keep putting up record crop production, that ends up leading to lower prices. And so one thing that's interesting is that prices have been low in commodities for a number of years. Farmers are suffering, but land values aren't falling. And so they're getting enough credit, they have enough equity built in that they're hanging on to their land, believing that there will be better times ahead in the future. So we are spending time looking at this. We do analyze the portfolio of banks to see how exposed they are. It seems like most people are able to get through it, But if you are the marginal farmer or you have a little extra debt, this is ending up being very painful for you.
Neel, it's pretty widely expected by investors that the Fed's going to be on hold, at least for the near term. Market can't figure out, though, if the Fed's next move would be to raise rates or cut rates. If you had to place a guess on that right now, what direction do you think it would be?
Well, that's probably not a bet I'd like to make, only because I don't actually know. I think that markets don't know because we don't know. It really is going to depend on the economic data, what happens with the tariffs and broader risk appetite for U.S. companies on one hand, what happens to the labor market, what happens to wages and inflation. And so right now, we put out this dot plot every 3 months. In my view, the dot plot has a very low signal-to-noise ratio right now, just because there's so much uncertainty that we're all wrestling with. We at the Fed are wrestling with it, but so are market participants.
Is there one number, one report, one market price that you watch more closely than anything else?
Wage growth. For me, in my opinion, we've been misreading the labor market for the past several years. We keep thinking we're at maximum employment. And then, wow, 200,000 jobs a month are getting created month after month after month. That can't happen if you're really at maximum employment while wage growth is modest. So I'm watching wage growth. It's you're trying to assess supply and demand in a market. If you want to assess supply and demand in a market, start by looking at the price. And the price of labor is wage growth. And so for me, until I see wage growth pick up to around 3.5%, given productivity of around 1.5%, that to me means we're not yet at maximum employment. And that's probably the most important determination I'm trying to make as a monetary policymaker.
3.5% on a year-over-year basis. And that's a number that we will watch very closely, too. Neel, I want to thank you very much for being with us. It's always great to see you.